Hi class. Today is the last lecture that is going to be related to our Sullivan, Wicks, and Culling Engineering Economy textbook. So we're going to be taking this opportunity to sort of cover briefly some of the other topics that we didn't quite get to throughout the class, given that this is a 1 credit hour online class. And then next week we're going to talk a little bit about how you're going to see engineering economics on the FE exam. But back to this week. I'm going to start with depreciation. Depreciation is the loss of value of assets. So basically, it's a book cost. If you remember what a book cost was from our first few lectures, it does not result in the cash flow, and it will factor into taxable income. So an example of depreciation is generally going to be something like buying a car. If you go out and buy a new car from Toyota today for $22,000, you drive it off the lot, it is no longer worth that much money. And then if you try and sell it, say 5 years from now, and you get $8,000 for it, that loss of value, that is depreciation. Is generally assumed to be calculated using a straight line method, which means that it's been depreciating it at the same rate over time. So for engineering econ studies, that method is assumed, even though it's not necessarily true, right? If you damage your car, then that is obviously going to result in an instantaneous drop in value, whereas something just going down because of wear and tear, that might be a more linear or gradual depreciation. The next thing we're going to talk about is taxable income. So companies are required to report their income and pay taxes based on their earnings. So what we need to do is figure out what the income is, figure out what the expenses are, factor in depreciation. So if the value of your assets go down, you have to factor that into your taxable income, and then whatever is left is your income that is subject to tax, and then it would also be where your interest is earned. So after tax, then that's where interest is earned on your money. So let's next talk about corporate capital. And what we mean by corporate capital is how is a company establishing its value. So there are really two ways that corporations can establish what their value is. There is debt capital, and then there's equity capital. And the company is required to go through a capital budgeting process to figure out how to invest their available cash in the best way to earn more cash and increase the value of their company. So debt capital, bank loans, and bonds. So basically debt capital is just borrowed money. If the money is borrowed from a bank, it is called a loan. Company will take out money from a bank, spend it on their project, and then be required to pay it back. And if they do everything right, the income earned from the project will help them pay back their loan and gain an additional income or revenue. Another thing that companies can do is sell bonds. These are essentially investment opportunities where the company will borrow money for a project with repaid interest, but instead of borrowing it from a bank, they're borrowing it from people who feel like they want to invest in the project. The return on the investment or the interest rate on the bond is supposed to compensate for the risk associated with loaning money to the company. So for low risk bonds, you're going to have a low return on investment and bond value. And for higher risk bonds, those are sometimes called junk bonds. Those will be high interest rates because the project might never come to fruition and you might never get your money back. So yeah, you need to have a high interest rate to compensate for that risk. Equity capital. Equity capital is basically consisting of the company's holdings. So shareholder investments, if you invest in a company through the stock market or your private market, you own a portion of the company. and the money that you invest will be in the form of stock. And what that's going to do is that stock value will change as the value of the company changes. So one share of a company is going to be worth whatever percentage of the 1 divided by the number of shares that they have out there. And when the company's total value goes up, the stock's value goes up accordingly. Company earnings, so any income that they generate from proceeding with their business, that is part of equity capital. And then cash from depreciation charges is also equity capital. So next we'll talk about funding projects. We've just discussed the capital budgeting project. That's for companies. They generally use their own capital to fund projects. So that will be obtained either through equity or borrowing, as we just discussed. As civil engineers, most of us will be working for, or not most of us necessarily, but some of us will be working for government projects. And the government uses taxes as well as borrowed money to fund their projects. So income tax and a variety of other taxes can be used to fund different projects, and the government is generally very transparent about what tax dollars can be spent on, so you can look that up if you're interested. And then the government will also issue bonds and go through banks to borrow money. Some examples of government taxes that can raise money, they'll be on either a federal, state, or local level. They all have taxes to fund projects, so depending on where you live, you will be taxed for different things and at different rates. It can be in the form of income taxes, property taxes, or other sales type taxes. So that is how most infrastructure is funded. Some of you may have heard of the gas tax. That is a federal tax that contributes to something called the Highway Trust Fund, which is primarily used to fund interstate highway projects. So the federal government will charge a certain flat rate for every gallon of gas sold. That will go into a large pool of money that the Federal Highway Administration then will distribute out to states who need to operate and maintain or build new interstate highway projects. Or occasionally there are opportunities for other projects. It's like streetcars and transit. Some other taxes, frequently sales tax will be levied to help support specific local projects. So when you go vote in your local elections, if you choose to do that, you'll often see some sort of transportation improvement plan tax that's going to be like 0.5% on sales taxes, and that would just increase tax in the area, but then would go to help support local infrastructure. That is about it for taxes. Thank you everybody for following this class. Again, next week we will be talking about the FE exam and how we can pass that, or at least the engineering economics portion of that, which will be fairly small, but you need to know it, and it's not too hard. So thanks again, and we'll talk to you later.